Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek, insight from the reporters and editors that bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Now let's get to today's second drop of some big bank earnings. Another round along with business updates from the Wall Street banks. We got today Morgan Stanley and Bank of America. B of A shares, we've seen them trade slightly lower despite fourth quarter profit beat due to high investment banking fees and strong net interest income. And then Tim, Morgan Stanley shares, we've seen them take off rallying following in the steps of what we saw in terms of share moves by Goldman, JP Morgan, and Citi. They reported yesterday. Morgan Stanley fourth quarter profit more than doubling, driven by strong trading revenue due to U.S. election volatility.
Here with the details on today's big bank results, we got Bloomberg Intelligence Senior Global Banks Analyst Alison Williams here in the Bloomberg Businessweek studio. Alison, Bank of America, a little preview for the close. Right now is going to be one of my decliners today. Why are shares lower?
I mean, yesterday I think was when there was a readjustment in terms of, we got the results yesterday. We had strong numbers, and I think Bank of America did deliver, right? They delivered on net interest income upside. The outlook is good. The outlook for cost is good. They're going to have operating leverage, but potentially wasn't the same magnitude.
Was it because they were already up 3% yesterday?
Yeah, I mean, so I think yesterday was kind of baking in, an adjustment for expectations. Like, okay, so we've seen this across the banks. We're probably going to get it from Bank of America. And as I said, they did deliver on it, but not necessarily, the huge upside that we're seeing at the capital markets focused Morgan Stanley and Goldman Sachs, for example. And so Bank of America, good growth in their wealth management business, but we knew that they had already talked about that, so that was kind of in line. And then, trading and revenue, yes, up, but not up 45%, which is what we saw at, 45% trading growth in Morgan Stanley.
Yeah, it's the traders, right, that seem to have really done super, super well. Even if investment banking fees are up, they're coming from, they're still not where they were when they were hitting record levels, right? And it was pretty anemic, like the reference point.
But to your point, what people are really focused on is this investment banking fee recovery. Investors and managements and bankers have been looking for it, ever since the downturn. And so now we're starting to see things pick up. We saw, IPOs in the fourth quarter, it was like a hockey stick. And so, the highest level in a few years. M&A backlog, Morgan Stanley saying today it's like the highest in, 10 to 15 years. Keep in mind that M&A feeds into all these other underwriting businesses. So that's something to be excited about.
Right. You do a deal for a company, you do like other business. We just had at the start of our broadcast, Rio Tinto and Glencore said to discuss a potential combination.
Right.
And,
Right. And that is, after Trump, we saw sentiment really drive all these banks higher. Part of that is less scrutiny on antitrust. And so that's meaningful, not for banks merging with each other, but for banks advising on more deals. And, we actually in BI, we did a deep study led by, my colleague Neil Sipes, looking at M&A and the cycle. It's a cyclical business. And, you can make a really solid argument that we could, M&A as a percent of market cap reached like new lows last year.
Yeah.
And you can make a case for that improving. Just as we said, less scrutiny, more sentiment as people feel a little bit more confident in the economy, the pro-growth economy, as Jamie called it. And really, if you get that improved sentiment, you can start to see more and more deals get done.
What did we learn in the last 36 hours about the way consumers are feeling about the economy? Specifically, Bank of America we often look to because they have such a good view on consumers
Correct.
here in the U.S. What did we hear?
We heard good things. It's a little hard to tell because the fourth quarter is really bolstered by all that holiday spending.
Yeah, I know. My credit card. I'm confirmed. That is confirmed.
Confirmed. And
every
now
January, I'm reminded of that.
And that's why in the first half tends to be the weaker part on the credit side, right? Because people are ringing up the bills. Spending is very strong, but then the bills start coming in. And so, the credit trends in that business are not great for the first half. But, in general, the credit picture is good. We haven't talked about credit costs. You didn't see a lot of headlines. That means that the story is good. Provision's actually coming in a little bit better than expected. When we look at reserves, so keep in mind reserves are thinking about the losses ahead. They're over the life, but they're also based on, economic scenarios,
right,
probabilities of those economic scenarios, and they're all telling us that, next year looks stable and solid.
What does the, kind of financial community, investor, analyst community, you guys think when it comes to those capital ratios? I know there's expectations under Trump that even that eases, right? Or it doesn't get amped up more. And so that's why we saw that Trump bump with a lot of these banking names in the last quarter of 2024. What's the view on that in terms of oversight and keeping them in check?
So the view post-Trump, to your point, right? Banks shares rallied. They were very excited. And it's not necessarily regulation rolled back, but less new rules. So the rule you're referring to is a new rule, and it's more punitive for the biggest banks. So again, these capital markets focused banks. So less regulation, more revenue. We saw a $20 billion buyback announced by Citigroup, 14% of their market cap, right? You saw those shares rally, but that is another thing that investors are focused on because the banks have been hoarding capital, if you will, right? Because these when the rules were introduced, they were extremely, I don't know if you want to say strict or punitive, but they were going to need a lot of capital. As people started to feel that, okay, these are going to get watered down, there was, comment by Powell that they're going to get watered down. So people felt a little bit better, but really post-Trump, people became very excited. And now with Barr stepping down, Barr was really one of the people that was looking for these banks to hold more capital. And so I think all of that positive momentum, investors are more positive, but managements are also feeling better about, okay, we may feel better about the capital situation.
That said, a headline coming in, you mentioned Citi eliminating more jobs this week. The bank aims to reduce jobs by 20,000 by the end of 2026. Headcount currently 229,000. How should we read into this? The story just breaking about 10 minutes ago.
So, I mean, Citigroup and Wells Fargo are a little bit unique because they are dealing with some regulatory issues, right? So there's a couple of things at Citi. First, they call it the transformation, right? So
just got about 20 seconds.
So getting that in control. But then they are also refining their business and honing their business, right? And so focusing on the parts that are more profitable. We saw the severance charges at Wells. It's not surprising that we're kind of seeing continued honing of the business at Citigroup.
All right. Yeah, they continue in terms of that transformation. All right. And Citi shares little change in today's session. Alison Williams, thank you so much. A lot going on when it comes to the big banks. Senior Global Banks Analyst here at Bloomberg Intelligence.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Well, the data are clear that the nation's current housing crisis stems from a lack of home building in the wake of the Great Recession more than a decade ago. Earlier this month, Bloomberg Opinion highlighting in a column how home construction never caught back up to the demand of a growing population. As a result, the United States has a shortage of about 4.5 million homes. This is from Zillow data. Surveys published last year, Tim, showed that more than half of all prospective home buyers were unable to make a move.
Larry Connor is founder and managing partner of the Connor Group. It's a real estate investment firm that owns and operates luxury apartments in high-growth markets throughout the South and the Midwest. The firm has more than $5 billion in assets under management. Larry joins us from Dayton, Ohio. Larry, good to have you with us. Just give us an idea of your footprint. And when we say luxury, what's sort of the demographic that your firm caters to?
Sure. First off, thanks for having me. Yeah, we operate in 18 cities around the country. We go as far west as Phoenix, Denver, Texas, Florida, North Carolina, and obviously here in the Midwest. And so generally it's going to be the renter by choice. But I would tell you the affordable housing crisis is real. Two, it's just not, for example, on the coast. I think it's in every city across America. But I believe the new administration absolutely has an opportunity to address this.
Well, and I'm curious, well, how do you think that they should address it? Because I think some might say, and I'm not being sassy here, so forgive me, but I know I'm going to get emails. They would say, hey, Larry, what can a luxury real estate investor kind of really tell us about what needs to be done when it comes to affordable housing? So let's start there.
Yeah, I think that's a fair question, Carol. So I would have three thoughts. And by the way, the backdrop is the new administration has the opportunity to unleash the power of America's free enterprise. The problem is the economics don't work for these developers. And I know a lot of developers and work with, even though we don't develop properties. And you say, okay, how so? Three ways. Number one, common sense regulations. Let me give you just one example. In California, there was a recent research paper. Approximately 30% of the total cost of a new home in California is based upon permitting and red tape.
Right.
That's not good. Okay.
Yeah, that's an issue that has been talked a lot about too in the wake of the fires, and even the governor suspending some of that red tape to try to get this stuff rebuilt faster. Go ahead. Sorry, I just wanted to jump in.
Yeah, Tim, you're absolutely right. And in California, the same research, it takes up to 4 years. So, three-pronged attack. Number one, common sense regulations. I think the Trump administration's well equipped to do that. Second, create low interest cost loans. Third, tax credits. But in return, put real teeth in the requirements that these developers, one, build a quality product, and two, over the long term, maintain it to high standards.
So Larry, I hear what you're saying, and I think a lot of people watching and listening would agree that regulations are a huge issue. The challenge, though, is the federal government doesn't really have much control on the regulatory front when it comes to zoning rules, when it comes to environmental policy rules, environmental review rules in individual states. How do you make it work at a federal level if these are local issues?
Yeah. Fair statement, Tim. The reality is it's a federal problem, it's a state problem, and it's a local problem. But somebody has to start. And the federal government and the new administration, in my opinion, are uniquely positioned to do so. For example, let's go to the low interest rate. Instead of borrowing costs for these developers at 7 or 8%, create an environment where they can do it at 3 or 4%. Now suddenly the economics work, and developers will develop tax credits. Every deal project you do, you need a down payment. Tax credits can help fund that. If you do that, developers will do it. But again, you've got to build a safety net of regulations.
Larry, why do developers always need tax breaks? I mean, you're not going to build in areas where you're not going to be able to sell properties, right? You're not going to do that because it would be a bad business decision. So I'm not sure I ever completely get this. I mean, I think, why not we give tax breaks to the homeowners that actually buy it and incent them to do it even more and to kind of make it even possible. We know that when, a homeowner buys a home, they're going to buy a lot of other things. There's a lot of economic activity that is created as a result.
Good question, Carol. Two-part answer. Number one is I agree, give the homeowner some tax breaks. Here's why tax credits. So you're going to build a project in wherever, in Ohio, in Cincinnati, Ohio. Well, if you get a loan, let's say through Fannie Mae, Freddie Mac, that loan is only going to cover, let's call it 75% of your cost. Well, you have to come up with a 25% down payment. A lot of developers can't come up with that. Tax credits, you can actually monetize. You can go out and sell those to investors who will buy those. Net, you can pay for maybe not all, but maybe half to 2/3 of your down payment. That's why, again, you come back to the realities. You got to make the economics work. If you do, you're going to unleash the power of all these developers.
So only got about a minute and a half or so left. 30 seconds. I want to ask you, though, if you could change one thing that you think would really create affordable housing, and it's not just affordable housing, but affordable housing in like major cities like New York and LA, where it's expensive and they're needed in those locations, not just anywhere, where people who maybe don't make a lot of money, but they work in New York City and they need a place to live. One change, 30 seconds, what would it be?
Reduce the cost and create the economics for it to work.
Larry, I like that answer because it was short and it gives me time to ask about your mission to space back in 2022. With the 1 minute we do have left, give us your outlook on NASA under the next administration and the role of private investors and the role of private companies such as SpaceX, Axiom, the company you went with to space and that to the ISS. What's your view over the next 4 years when it comes to the U.S.'s role in the cosmos?
Well, if you ask my opinion, the future is space. And it's important that the United States lead and control space. Second, I think, again, you partner the private sector with the public sector, and the power of being able to do that can be unbelievable. Me personally, I was fortunate. 17 days in space, extraordinary. Well, what's not known is that 10 months of full-time training behind the scenes. We were not space tourists. We were private astronauts who had to meet or exceed most of the NASA astronaut requirements.
All right. We got to leave it on that note. Larry, great to get some time with you. Larry Connor, founder and managing partner of the Connor Group.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, Treasury Secretary nominee Scott Bessent warned that the U.S. faces an economic crisis that will hammer middle and working class people if the 2017 Republican tax cuts are not extended when a swath of them expire at the end of this year. Bessent making these comments, answering questions at his Senate Finance Committee confirmation hearing today. He also touched on the independence of the Fed during that hearing.
I'm asking you, but let me just say, you don't deviate from our conversation that you think that there should be independence.
I think on monetary policy decisions, the FOMC should be independent.
Thank you. I appreciate that.
Indeed, here at Bloomberg, we've been talking a lot about Scott Bessent in recent months, yet for many people, he wasn't a familiar name, especially those in Republican political circles before Donald Trump nominated him to be Treasury Secretary. Still, as Bloomberg Businessweek columnist Josh Green writes, the macro hedge fund executive beat out several rival contenders to get the nod for one of the most powerful jobs in global economics and finance. He managed to convince both MAGA populists and Wall Street that he was on their side. Josh Green is a Bloomberg Businessweek national correspondent. He's also the author of several books, including the #1 New York Times bestseller, Devil's Bargain, Steve Bannon, Donald Trump, and the Storming of the Presidency, as well as The Rebels, Elizabeth Warren, Bernie Sanders, AOC, and the Rise of the New Left. Josh joins us from Washington, D.C. Josh, I had no idea Steve Bannon was such an integral part of Scott Bessent's sort of rise in Republican circles. Explain the relationship there and what Bessent did during the first Trump presidency and then over the last 4 years.
Yeah, Steve Bannon he's kind of like a MAGA Forrest Gump. He just sort of shows up in everywhere and everybody. But as I wrote in Bloomberg News this week with my colleague Saleha Mohsen, we did a big profile of Scott Bessent, the likely next Treasury Secretary, basically trying to answer the question, like, who is this guy and where did he come from? I was watching an event at Mar-a-Lago earlier this month, and Trump on stage kind of just stood up there and was like musing to the crowd, like, hey, there's Scott Bessent. Who's ever heard of this guy? And it sort of struck me as like that really is a question to answer about Bessent. And of course, this is what senators are trying to find out. We're trying to find out in the hearings this morning. Bannon came into the picture because Bessent, for most of his career, had been a low profile but very well regarded hedge fund manager for George Soros's fund in 2015, 2016. He launched out on his own. The Key Square Group was his hedge fund. And shortly after Trump's inauguration in 2017, Bessent is a macro investor, which is very curious to learn about these new forces of populism that are obviously roiling governments and markets across the world, and wound up paying to attend a Credit Lyonnais conference in Hong Kong, where he sat next to Steve Bannon, who had recently left the White House. And from what Bannon describes, they basically had a 2-day debrief on all things Trump and have been in touch ever since. And when Bessent made up his mind that he wanted to have a position in the Trump administration, Bannon was one of the people in his ear helping advise him how to land the Treasury Secretary role.
You know, I think about this, Josh. There are a lot of politicians out there, individuals who kind of start to align themselves or start to play to Donald Trump. But what's so unique about what Bessent did that really made him such a standout to ultimately get one of the top jobs, or at least nominated for one of the top jobs in this administration, upcoming administration?
You know, what stood out to me about him, and I think Saleha, my co-author, also, was that what you've tended to see across two Trump administrations is that the key figures tend to either come from the traditional world of Wall Street or GOP politics, or they come from the kind of hard right Steve Bannon, MAGA, Breitbart news world. And what was so interesting about Bessent is that he emerged out of the Wall Street world, but over the last 7 or 8 years, he's really become a sort of a prominent and well thought of person in the MAGA world also. Bannon was one of his most vocal and outspoken supporters during the long race to become Treasury Secretary. And I think it was the fact that Bessent has managed to win over kind of the two key components of Trump-era Republican Party that explain how a guy like this, who doesn't have the profile of like a Gary Cohn or some of the more famous Treasury secretaries of the past, wound up getting this role.
I love this part at the top of the piece where you quote Steve Bannon, who says he went to Ivy League and has an elite Wall Street pedigree, but he's a true populist. He's MAGA to his core. And then you also quote, just after that, Stanley Druckenmiller, who says Scott has very conservative views, but they are not necessarily orthodox or populist. So what is he?
To me, I just thought this was a great way of framing the kind of chameleon nature of Scott Bessent's political appeal. The fact that he has, the talents and I think the credibility to appeal to a guy like Bannon, while at the same time, having loyalists like Stan Druckenmiller, who's about as credentialed a Wall Street figure as you're liable to find. Now, I think the challenge for Bessent is going to be that, once he's confirmed, I think the expectation is he'll be confirmed fairly easily and becomes Treasury Secretary. You can't be a friend to all people. You have to sort of choose sides, and ultimately you have to do the president's bidding. And so he is going to have some, I think, very difficult situations in the coming years and months where, one group is going to want one thing and another group is going to want another. If Trump wants to slap on global tariffs, that's going to make a lot of Wall Street folks very nervous. If Bessent wants to focus on tax cuts and not do any of the tariff or the MAGA stuff, that's going to make people like Steve Bannon upset. And so, as we write in the piece, Bessent has a very narrow tightrope to walk, and it's going to be interesting to see, if he is able. He is a newcomer to high-level politics, is able to pull this off.
Well, and I think about in moments of crisis, whether it's the great financial crisis or, even the pandemic, you need a Treasury Secretary who really figures out what really needs to be done to kind of get us out of a financial crisis. Is this someone who would stand up to Donald Trump should he need to be in terms of policy initiatives?
It's a good question, and it is the question that everybody wants to know in Washington, on Wall Street. And my lame cop-out answer to you, Carol, is that we don't know yet. That's one of the big questions around Scott and, frankly, everybody in Trump's inner circle. Standing up to Trump is difficult. As a senior administration official was telling me when I asked him this question for the piece, he said, you don't stand up to Trump. You don't engineer a confrontation. What you have to do is manage his impulses and help translate what he wants to do into policies and language that isn't going to spook global capital markets. And I do think that because Scott Bessent has such deep market experience, this isn't a guy who's been holed up in the academy thinking about theory. He's been out there running a fairly successful hedge fund. I do think that is a skill set that he possesses. Now, whether or not he can convince Trump to walk a straight and narrow path, well, I would say I don't think anybody's able to kind of quite do that all the time.
Yeah.
But I do know that there's a great deal of relief on Wall Street and Republican circles, and even quietly in Democratic circles, that Bessent is the man going to inhabit this role rather than some of the other choices who I don't think had that level of experience and that degree of trust that they know what they're doing when it comes to managing the levers of the economy.
Can he be a servant to two different sides? Can he be a servant to Wall Street and to MAGA as well? Can he pull that off?
I don't think you can, because on a lot of issues, including issues that are going to be central to what a Treasury Secretary does, the two camps are sort of diametrically opposed, right? Wall Street doesn't want tariffs, the MAGA crowd does. And so, we've gotten a preview of how he might try and manage that. Bessent actually showed up at Bloomberg's DC office last summer and sat down for a long and interesting editorial talk with me and some of my colleagues. One of the proposals he'd mentioned about how you kind of split the baby was, well, maybe we could have a friends and family plan for tariffs. Our allies would get lower rates, and adversaries would get higher rates. So you could already see kind of the gears turning in his mind of, how can I carry out Trump's policies in a way that reflect what he wants without upsetting markets to a degree that it causes a recession, a return of inflation, and so on. And so that's why I think he's going to be one of the most interesting figures to watch in the upcoming Trump administration.
Well, it's a fascinating story to read. Josh Green, thank you so much. Bloomberg Businessweek national correspondent. This is Business Week.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
The numbers out of LA just absolutely astounding. The flames have killed at least 25 people. Dozens still remain unaccounted for. They've upended life in America's second largest city. Carol, with more than 300,000 Los Angeles County homes and businesses still without power, many schools either destroyed or badly damaged.
All right, for more, we turn now to one of the nation's most respected voices on climate change, the environment, and public health. Gina McCarthy is former U.S. EPA administrator and first White House National Climate Advisor. She's also managing co-chair of America is All In Coalition. It's a group of leaders from all over the United States that supports climate action. She's also operating advisor at Pegasus Capital Advisors and a senior advisor at TPG Rise Climate Fund and a senior advisor at Bloomberg Philanthropies, the philanthropic arm of Bloomberg LP, which is, of course, the parent company of Bloomberg TV and Bloomberg Radio. She is a busy individual, but it's her expertise in terms of climate that everybody is drawing upon. She joins us from Boston, and we do as well. Gina, nice to be talking with you. The last time was at our Bloomberg Green event last fall. We do want to start with the LA fires. We are still waiting to see what the cause was, but yet many would argue that climate change exacerbated the situation. No rain for 8 or 9 months. How are you thinking about LA and what has happened there?
Well, first of all, it's great to be back on the show. And my heart does go out to everybody in this area. It's really feels like I'm watching climate change crisis in action when I'm looking at what's happening in the devastation. Look, 2024 was the warmest year on record globally. And what we saw in California was extreme heat and a lack of rain. We saw 100-mile-per-hour winds, and that just led to a recipe for disaster. And I think we have to be prepared. We have to understand how we can be more resilient, how we can adapt, and look at some opportunities we have to really begin to tackle these issues and stop the climate denial that keeps holding people back. You know, these extreme weather events cost American families more than $150 billion every year.
Wow.
Isn't it time for us to really recognize this and take action?
Administrator, you said we have to be prepared. Was Los Angeles not sufficiently prepared for this latest round of wildfires?
No, that wasn't what I was suggesting. I mean, it was a confluence of issues that actually led to this challenge. But my point is that we have to, moving forward, understand that with the advent of climate change and with the challenges that we're facing, we have to understand that a shift to clean energy is essential. Reduction in our need for fossil fuels is essential, because we cannot allow this to continue to exacerbate. This is not just the start of this problem. This is not yet answered. And it's time for us to develop a strategy in the United States to work with other countries to really start focusing on this clean energy zoom that we need to advance.
Well, you know, the incoming president, Donald Trump, of course, being sworn in on Monday, has talked about more drilling in terms of fossil fuels, and certainly seems to be a much more sympathetic ear in terms of the fossil fuel industry. Having said that, time will tell in terms of whatever policies we see, but any increase in reliance on fossil fuels, that's a problem in your view? I'm asking with a question mark.
It's inconsistent with what we know we need to do to address climate change and keep people healthy. That's the major challenge here. And so the good news is that we have answers here. You know, clean energy is literally booming. We now have federal investments that are really changing the game here. We have the bipartisan infrastructure law, the Inflation Reduction Act. All that means that we now have more than 400,000 new clean energy jobs that have already grown just in the past 2 years. Mm-hmm. We have 751 new clean energy projects out there. We're talking about money and jobs in rural communities. We're talking about in low-income communities. And this is our opportunity. This is how we're going to prevent the continued devastation that we're seeing and begin to realize that clean energy is our answer, and it is cheaper for families. I mean, we are talking about great news here on clean energy investments because it is lowering costs, but it's also opening the door to a whole lot more energy choices, like solar, which is 33% cheaper than gas power. That translates into a 95% reduction in utility costs. This is a big deal, and it is an opportunity.
But
it's not a punishment.
But Gina, you know, we rely still so much on fossil fuels at this point, right? And many would argue, even green energy folks will say, you know, we still kind of need a hybrid approach in terms of energy, because everything on the alt side, whether it's, and increasingly people are pointing to things like nuclear or geothermal, but even solar and wind, it can't meet the demand that is out there today, and that we still need to rely on fossil fuels, unfortunately, some might say, for a few more years.
Well, part of the challenge that we saw, you're absolutely right. I am not suggesting that we reduce our energy demand or our energy in a way that's going to impact families. We need to address our energy challenges, but we can do that over time by increasing clean energy and watching fossil fuels be higher price, which they already are now, and phase out. So this is not an all or nothing, nor is this an opportunity to threaten people's lives. We have to keep energy out there and moving and strong. But we can do that in a way that saves families money. We can do that in a way that lowers our air pollution challenges. We can do it in a collaborative way internationally so that we meet our responsibility to other countries as well. And so I'm excited about the opportunities now. I am not looking to shut the spigot off of fossil fuel tomorrow. I am looking at this as an opportunity to ensure that clean energy can progress, because it is the winner. It's the winner for our families, it's the winner for our pocketbooks, and it is certainly a winner in terms of the health and safety of our country and how to move forward.
Do you think
so we just have to continue to be leaders on this.
Do you think we can continue to be leaders on it during the next Trump administration, given the way that the president-elect has been outspoken about his disdain for renewable energy and his support of the fossil fuel industry?
I think it's going to be very challenging. It was very challenging during the Trump administration. But one of the reasons I've been working with Bloomberg Philanthropies, as you indicated, is that we're working on a program called America is All In. It's an unbelievable opportunity for governors and mayors, local community leaders to work together to fill in the blanks when the new administration might want to waver. Look, most of the money in the IRA, the Inflation Reduction Act, is actually going to Republican districts. You can see it. That's when most of the projects are being built. So they would have to be sort of challenged to not realize that we have to move this forward, and it's just as important in Republican districts, if not more so than in Democrat.
Gina, one thing I want to ask you, you're a senior advisor at TPG Rise Climate Fund, operating advisor at Pegasus Capital Advisors. We have spent so much time, I feel like over the last decade, even talking about the intersection of money from, financial markets, capital markets, the private sector working with the public sector. What are you hearing from, your experiences in working with those folks who manage a ton of money and can put it to work and make things move in the green space? We understand there are commitments, and then there are really strong initiatives that move the needle. And especially under a Trump administration, where I think many would argue too that they don't necessarily want to make the incoming president look at them negatively and get negative attention. So I don't know. What's your hope for the next couple of years and that intersection of money that moves things?
Yeah, I think you're going to see continued investment in the private sector. No, they may not be standing up and saying, I'm doing this or that. But there's no question about it that we are not seeing private sector investment or public sector money waning. It is actually an opportunity of our lifetime. And I think that, even if President Trump doesn't want to admit it, we are highly dependent now on clean energy. We have to be. We cannot go back. We don't have that as a choice. And the exciting thing is we don't have to. So right now we know that Republican districts are heavily invested in this, as are the Democrats. We know we have governors. We know we have leaders in cities and communities that are going to keep pushing forward. So this is all about the entire United States of America recognizing that we're facing a world challenge that we not only helped to instigate, but can actually become leaders in moving forward. And the companies that I'm working with are all in on making that shift to clean energy and recognizing that that's where we're going to actually make the most benefit for our communities today and build a stronger America tomorrow.
Administrator, 30 seconds left. President-elect Donald Trump's pick to lead the EPA, Lee Zeldin. He did tell a Senate panel that he believes that climate change is real. What are your thoughts on him as the pick? 30 seconds.
Well, that was better than answers I've seen from other people. Look, Lee Zeldin is a bit of an unknown. I know that he has made some decisions in New York that seem to be very good ones from both an environmental and climate perspective, but I've also seen him do work that seemed very negative around climate change and making progress. So we'll have to wait and see. It's very easy to go in front of a committee and answer questions, or now apparently avoid most of them. But we have to work together. We have to understand this is about people, not politics.
Well, we so appreciate getting time with you again. Gina McCarthy, former U.S. EPA administrator, first White House national, also white climate advisor, I should say, and she's also an advisor, senior advisor at Bloomberg Philanthropies.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we are just about 19 minutes away from the closing bell on this Thursday, January 16th. Carol Massar, Tim Stenovec, live in our Bloomberg Interactive Broker studio. You heard Bill Maloney and Charlie breaking down the trade here. We are definitely off our highs of this session. I'm looking at the S&P 500, still about almost 400 names, Tim, to the upside. But again, it's kind of, I feel like, an anemic trade a little bit here.
Okay, you mentioned earlier what's going on with yields. Earlier this week, Carol, the yield on the 10-year hit a high of 4.8%. It was the highest going back to November of 2023. It's backed off a bit. Our next guest, though, says not so fast, and we're going to see 5% this year.
All right, so let's see what Max Wasserman has to say. He is, of course, founder and senior portfolio manager at Miramar Capital, registered investment advisor, independent, I should say. He joins us from Northbrook, Illinois. Max, good to have you here with us. We kind of, just like the Fed, seem to be data dependent in terms of the sentiment and the moves in the market environment. How do you see this trade? Are there any clear trends that are emerging in your view, or it's going to be a bit of a wait and see mode because of what we get from the new administration, what we get from economic data, and what that will mean in terms of Fed policy?
Well, thank you for having me on. And I think it's a combination of both. But I think what we've seen is a Fed that is recognizing that inflation's a little bit stickier than they thought, and that you have growth roughly around GDP, roughly around 3%, yet core CPI roughly about 3%. And it really is hard to justify, in our opinion, why they cut so aggressively last year at 50 basis points and then followed up by another 225s. If you have nominal GDP around 5.5%, 6%, we don't think it warranted a cut. So what you're going to see now is, we think, pressure from the new administration. New administration's talking about tariffs, talking about a potential embargoes and restrictions. So we think that's going to be a little inflationary. Also, if you think about immigration policies. So we think that a 10-year treasury around 450, 460, that's great, but we see more pressure pushing it upward as deficits start to rise. Also, the current administration that's coming in, they're talking about cutting taxes even more. I mean, let's not forget, they were trying to get rid of Social Security tax, taxes on tips. So we see a lot of spending taking place, and you may not see the tax cuts or their spending cuts that they're being promised. I mean, already I think Elon Musk is saying $2 trillion was a little aggressive, maybe more towards $1 trillion. And we think as time goes on, there's more risk to the upside in interest rates than there is downside, in our opinion.
What brings rates down ultimately, or is this the new normal? At least based on what happens fiscally over the next few years.
I think a slowdown in the economy. I think if you see the demand significantly slow down. But keep in mind, there's going to be pressure to refinance. There's a lot of debt that's coming due. You're dealing with about $1.2 trillion annually in debt service cost. So, and a lot of paper is going to be rolling over. So that's going to eat up on some of the federal budget and spending. But I think the only way you really see interest rates coming down is if you see the economy substantially coming down, right? And unemployment ticking up. But again, if you're talking about immigration, right, reform, you're talking about shutting the borders and deporting a lot. That's a lot of labor that's going to be leaving the economy. And that means inflation, we think, to wages. So we think right now you could actually see the 10-year go up to 5, 5.25. And we don't think this market is really pricing in that scenario. And we're not saying that it's going to definitely go there. We think there's a high probability if the current president is coming in, gets what he wants. We just don't see how that brings interest rates down in the next 6 to 12 months.
Right, but higher rates in terms of certainly some of those higher or big tech names that have had quite a run up, or their valuations, right? You've got to do somewhat of a reset. Having said that, you do still like Microsoft. You like Qualcomm at current prices. Is it just a price thing, or is it a fundamental thing? Let's start with Microsoft.
Sure, I think it's a fundamental thing, basically. I mean, they're monetizing with ChatBTC, they're monetizing their business, and the prices come down, right? And even though it's a software company, right, they tend to get higher multiples, let's say a hardware company. So I like where they're positioned. They're spending a lot of money. I mean, it's one of our largest positions. We wouldn't be jumping in full boat at this point. We'd look for any further pullbacks, but you could start, in our opinion, you could start a position here. But realizing these are not cheap. Qualcomm, we think is a little bit different story, trading at 15 times earnings. And we think as they expand into the Internet of Things, as they start expanding into the PC market, that could be a new growth potential for them. They're only trading at 15 multiples, and it's been more of a depressed multiple in that stock. And the stock was trading at a much higher rate. So we think here, along with even Google and all three of these companies we have investments in, we think they have a better upside potential. But the NASDAQ in general, trading at 37 times, right, after 2 big years, is not, and it's really become an interest rate sensitive play. If you think about it, every time interest rates tick up, they come down. So at this point, I think everybody recognizes the growth and they're paying for it. So we think there's very limited upside in the NASDAQ this year, but we think there's a lot of upside in the other parts of the market.
Well, let's talk about another part. It's actually a part that we talked about, the defense part. We talked earlier about Anduril Industries selecting Ohio. They're going to create this sprawling new manufacturing facility that's going to make a lot of autonomous systems and weapons, and they're going to be doing that on an annual basis. But you like some of the kind of old line defense guys, and I'm thinking
those are the ones that Anduril wants to disrupt.
Exactly. So Lockheed Martin or General Dynamics, why those two versus someone else?
Well, again, we're dividend investors, so we like dividend growth, and both of them have dividends roughly around 2 and 2.5% percent respectively. If you look at General Dynamics, 20% of their business is the Gulf Stream, and they're bringing on more onlines with the G700s, and we see that side of the business really going up. Also, we think the demand for their products. I mean, you're going to need the submarines, you're going to need the strikers, you're going to need the tanks. So we think the demand is not going away, as we do not see global disruption calming down that much, right? We see it in the Middle East calming down, but you still have to do with Ukraine, you still have to do with Asia and Europe. So we think demand. And we think Lockheed. Who's building the planes? I mean, we have to look at the fighters. And if you look at it, there's going to be disruptors. But we like safety, and these two are behemoths, right? And so with you have that dividend growth, and we have the budgets that are put in there, we feel very comfortable, especially they've come down about 10%. So we like them here.
Okay, we got 30 seconds left for you to talk about energy infrastructure, Williams companies. 30 seconds. Why are you optimistic?
I'm optimistic on the pipelines. They're not cheap right now. Both that and ONEOK, we have an investment. They've gone up like 50% last year. But they service the natural gas like 30% of the U.S. So, and there hasn't been any build out in the pipelines. And if you're going to become more energy independent and more production, you've got to move nat gas throughout the country. And they have that market. So we like them a lot. Paying a nice dividend of about 3.5%. ONEOK is closer to 4%. And they've just had an acquisition of Magellan. So we like the pipelines because you have to move energy throughout the country. And there's been no new pipelines in this country.
All right, Max, thanks so much. Love talking stocks with you. Max Wasserman, founder and senior portfolio manager at Miramar Capital, joining us from Northbrook, Illinois.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.